Okay, everybody, and hello. Let's take a look at exercise 7-15. So here we have on April 1st, Rashid assigns $400,000 of its accounts receivable to the Third National Bank as collateral for a $200,000 loan due July 1st, 2020. So it's a 3-month loan. The assignment calls for Rashid to continue to collect the receivables. Third National Bank assesses a finance charge of 2% of the accounts receivable, and interest on the loan is 10%, which is a realistic rate for this loan of this type. So if I'm just kind of pledging my receivables or just assigning them without them physically transferring, especially if I'm continuing to collect, they're essentially serving as collateral, meaning that if I default on the note that I'm signing, then that's going to be what essentially that's what they would be able to collect. So let's take a look at April 1st. Okay, so on April 1st, I'm borrowing money. Okay, so and I'm getting a $200,000 loan. However, I'll get $200,000, but I'm not going to get the full amount. The Third National Bank will assess me a finance charge of 2% of the accounts receivable. So the amount of accounts receivable that are being pledged as collateral is $400,000. The finance charge is 2% of this amount. So right over here. So basically the percentage of AR finance charge. So over here, my finance charge is going to be $8,000. Now, the reality of this is kind of somewhat a little bit more interest expense, but you could call it a financing charge expense, do something like that. But the reality is the cash that we're going to be receiving is not going to be the $200,000 loan. It is going to be $200,000 minus the $8,000 finance charge. Okay, so over here, the note payable or the loan is going to be at $200,000. And then over here, I'm going to have either finance charge expense or interest expense. And this is going to be $8,000. And this is going to be record receipt of loan proceeds. Okay. So this is what we're going to do here on April 1st for Rashid. Now prepare the journal entry for Rashid's collection of $350,000 of the accounts receivable. So this would essentially be from April 1st through June 30th. This would be a debit to cash, credit accounts receivable. Okay, so right over here. And then lastly, on July 1st, Rashid paid Third National all that was due from the loan it secured. Okay, so right over here on July 1st, 2020, how much is going to be paid? Well, you've got $200,000 here, which is the loan amount. The interest rate is at 10%. So the annual interest is going to be $20,000. However, I did not borrow the amount of the money for the entire period. What I did do is I borrowed it though for 3 months, or April, May, and June. So what I'm going to do is I'm going to multiply this by 3/12, or April 1st through June 30th, which is 3 months. So when I multiply this by 3/12, I get $5,000. So when I pay back the loan I'm not only going to be paying, obviously I'm going to be getting rid of it because I'm paying it off, but the amount of cash that I'm going to be paying is going to be the loan amount plus the interest on the loan. So the total amount of cash I'm paying for this loan is going to be $205,000. And my balancing entry is going to be to interest expense. Okay. So that is my journal entry for this particular one right over here. These are my journal entries. So there you go. In any event, thank you for joining me here today, and I look forward to seeing you on the next video. Have a great one.